What's up, everybody? So today we're going to talk about the Section 1031 exchange. So essentially, imagine if I told you that you could sell an investment property, pocket a huge gain, and also pay $0 in capital gains taxes, and it's all completely legal. So it sounds like a loophole, but it's actually not a shady loophole. It's written right into the tax code, and it's called a Section 1031. And only the wealthiest of the wealthy real estate investors in this country use it, and they use it constantly. Okay, so if you're new to this channel, my name is Sargis Ivanov with Next Level CPA, and in the next 5 minutes, I'm going to show you exactly how it works, the mistakes that blow it up, and a real example. So let's get right into it. So here's the deal. So a 1031 exchange, which is also called a like-kind exchange, it lets you sell an investment or business property, and it rolls the proceeds into another one without paying the capital gains tax that you normally owe right away. So the key word here is defer. You're not exactly erasing the tax, but you're kind of just pushing it down the road, just kicking the can and keeping that money working for you today. So think about it like this. Instead of having 20 to 30% of your gain go to the government, all your equity rolls forward into a bigger, better asset that keeps compounding, and that's how investors build serious wealth. So it's not all fun and games. There are some common misconceptions, so let's just clear these up one by one. So myth one, a lot of people like to say that like kind means the exact same type of property. So that's wrong. You can actually swap a duplex for raw land or raw land for an apartment building. It doesn't need to be, for example, if you're selling a strip mall, you don't have to buy another strip mall. Myth number two is that you can do a 1031 on your own home. That is completely incorrect. Your primary residence does not qualify. So this is an investment property or business property only. There are cool exclusions for personal properties. That's called the Section 121. So that's a completely different thing. Myth number three is that the tax just disappears. So kind of like we mentioned in the intro, it's not deferred, it's deferred. It's not forgiven, at least while you're alive. So with smart estate planning, your heirs can actually inherit the property on a stepped up basis and wipe out the gain entirely. That's the only time where the tax would disappear. Once you die and once you give it to your heirs. So myth number four is that you can peel off a little cash for yourself. The thing about that is, yes, you can, but if you pull cash out, that's called boot, and that portion gets taxed. The exchange still works, but if you need 50 or 100,000 out of the deal, only that portion would be taxed. Okay, so now let's get into the actual technical side of things. So rule number one, you need a qualified intermediary. And what that means is that you are not allowed to touch the money. It has to go to a neutral third party, someone called a qualified intermediary, and they have to hold the sales proceeds until the next purchase. Another rule number two, is the 45-day rule. So from the day that you close the sale on your property, you have 45 calendar days to identify your replacement property in writing. Okay, and you can choose up to 3 properties. Rule number 3 is the 180-day rule. So you have to close on that replacement property within 180 days of the sale. Full stop. Okay, and to defer the entire tax, you generally need to buy something of equal or greater value and reinvest all of your equity. So buy cheaper, and the difference becomes taxable boot once again. So if you are selling a $500,000 property, make sure to at least buy $500,001 property. Going along that line, let's look at a real example. Let's meet our investor, Sarah. Years ago, she bought a rental house for $300,000, and today it's worth $700,000. So she wants to sell and level up. Her gain's going to be roughly $400,000. So without a 1031, she's looking at paying well over $80,000, $90,000 to the government. So instead, what Sarah does is she uses a qualified intermediary. She identifies a $750,000 apartment building within her 45 days, closes inside 180 days, and rolls all of her equity in. So her capital gains tax this year is going to be $0. That's roughly $90,000 that she just got to put into the next property, into a bigger property, and that's essentially the power of a 1031. So the rules are strict, I'm sure, as you've gotten to know by now, and the deadlines are brutal. So if you miss a date, if you touch the cash, or if you misidentify the property, you're going to owe the full tax bill, and there's no do-over. And that's exactly where we come in. So at Next Level CPA, we structure 1031 exchanges from start to finish. That includes the timing, the intermediary, the paperwork, so that nothing slips and you don't lose your hard-earned money. We're taking on new clients, so if you're even thinking about selling an investment property this year, talk to us before you list it, because with the 1031, timing is everything. I'm going to put some links in the show notes. If you like this information, please subscribe. We're going to try to start breaking down tax strategies on a weekly basis so that you can keep more of your money in your pocket. So we'll see you in the next one.